Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susi.
It's Friday, January 21st, 2022.
End of the year, the beginning of the year.
That's right. Yeah. Yep.
How you been?
Okay. Out of COVID protocol.
Good.
Out of the cave. My wife had COVID. And so I just came out of the cabin.
Oh, I'm glad. We missed you last month, so glad you're back on the...
I got to find my razor.
Yeah.
And my... I got to go shopping. I got to lose 20, 30 pounds. So
with my health issues
I'm
too.
on style.
I know.
That's all in process. So to kind of clean up from
the holidays,
everything. I got a hat on because I didn't want the glare from my head.
I love it.
Anything. So
it's good, man.
How you doing?
Hanging in there. It's been busy. Folks, a little bit of health issues with the folks, so dealing with some of that, but. Never a dull moment, and certainly not with the markets. But let's first, I guess, get into a little bit of the recovery tracker and what's going on with the latest here. What are you seeing?
Yeah, I think, the economy is still opening up and growing, obviously. And, there's some speed bumps, I guess, along the way. The thing that I guess jumped out at me the most was the staffing index.
Yes.
Right. So,
right. Yeah.
Which measures the kind of the temporary workers. And
I think it had a good year end and then sort of curled, right?
Yep, dropped down. Yeah, pretty. Yeah.
It's a leading indicator. Watch out.
Yeah. So that, but we'll have to keep an eye. Retail sales, right? We're heading into earnings season.
Yeah. And, I hear you.
So it's
okay. There's a lot of good charts on there.
Cautiously optimistic, I guess.
Amen. That's exactly the word we're using all year long. So
yeah, crazy times.
Pretty much. I mean, we'll jump around a little bit here, but first half of the year, I think it's going to be a little more challenging, right?
Sure.
And just sort of, hey, what's going on with the markets? Sandy and I, we made changes, be as proactive as we can with rebalancing, use different.
Yep.
Asset classes, alternatives, but also high quality, right? I think.
Dividend stocks, high quality, domestic, international, short up the bonds on the, high quality corporate, short durations. Right. Still have some healthcare exposure, telecommunications, infrastructure. So we're very well diversified, but but still, right? Markets are crazy. Even a diversified portfolio is going to drop, and
he is drop less. With the QQQs, NASDAQ down over 12, Russell's down over 15,
Sure.
So, you can't stop all losses, but the nice thing is a diversified portfolio, like I said last month, finally will outperform the past 2 years. So this is our year. We're going to shine. So it's going to be challenging first half of the year. We talked quads, 1, 2, 3, 4. We're in a quad 4 right now. So last month I talked briefly, it could be a shallow quad 1, which is good times, or a shallow quad 4. So the first quarter of 2022, we're in a shallow quad 4. This means things are slowing, rolling over. No recession. We don't see a recession this year. Mm-hmm. Real simple. It comes to this, really with the Fed. So Fed pal, he's going to be driving the bus here. If he raises rates 3, 4, 5 plus times that they're talking about doing, we'll be in a recession. Okay, so you heard that first from us there. Hopefully, he does not raise rates right away in March once the Fed bond buying is done and all that. Mm-hmm. So if he does not raise rates and just taps the brakes and cools things down, let the markets absorb things. That's what the markets are anticipating, a rate hike into a slowing economy. That's why you have the redness today. Redness pretty much all year. We tapped out the highs the first week of January. Since then, caved. So that's what's going on. So it's a shift in quads, shift in markets. The market's trying to adjust. So we got ahead of things as best we could, diversifying the portfolio. So if he does not raise rates, the markets could have reprieve and actually go back up. So, active management, a lot of tactics will be going on these next, let's call it 4 or 5 months.
Sure.
We'll see a lot of more than normal activity just because we have to pivot, make adjustments to what the Fed's doing.
Yeah. So the market's kind of the stock market is ahead of that, some of that stuff.
Correct.
Right? So So it's
at least 3 months ahead.
So right, as things are down because it's anticipating that they're going to increase rates. So if the Fed comes in and says, "Hey, you know what? Things are slowing. Let's
pause.
Yeah, let's be careful here." And then the market's
great.
Stock market's
reprieve,
like that.
Get a floor, move up. You have over the next month, next 4 weeks. So we raise some cash, move things around, but you sell into the quarterly earnings. The fourth quarter earnings are being announced. They're not all that great. Yeah. So getting into quarterly earnings. So 60%, and Andy and I, we spoke briefly about this over all last year, 60% of S&P earnings cite negative impact of labor costs on Q4 earnings calls. This comes from FactSet. So again, we talked about the wage increase, and folks, you've seen our charts before on the wage increase. So once you increase from $12 to $15 or $12 to $18 an hour, you're not going to take that back. Yeah. So it's here. It's getting pushed on. Inflation. I know it's talked briefly about inflation. Inflation prints 7%, highest in 40 years, basically. So 7% CPI, Consumer Price Index inflation. So that's the high point, highest almost 40 years, is what it is. We are peaking, like I said last month as well, peaking November, December, January.
So not 19% inflation.
Not like the Carter years. But anyways, as far as inflation. So with that, so parts of inflation are going to curl over. Used car prices are curling over. Other parts are still going to be elevated. So the overall inflation, instead of a 7 print for 2022, it might be a 5% print for inflation, or possibly lower.
Sure.
We'll see. But the point is, it's not going to be as high as one anticipates. Hence, hey, Fed, don't try to raise rates, hint, hint, because inflation's already peaking.
Yeah.
We'll see if they get it.
Yeah.
So we use plenty of Argus research, Hedgeye, NDR research. So everyone's all over the place in forecasting S&P, this and that. So that's why we mentioned, front half slower, back half better.
Yeah.
Also, GOP in November term, get the House, Senate, boom, year-end rally, November, December. We anticipate that.
Yeah.
A lot of the analysts are anticipating that as well. So just have to grin and bear it. Let us do our magic as far as navigate the treacherous waters we're going through right now. And then, things should look better later on.
Yeah.
It goes down to Powell, though. It really does. He needs to wake up.
Sure. Yeah. It's I guess the stock valuations were overstretched, right?
Oh yeah.
So the good thing we have, what's one way to help that? You have a drop in the market.
Have a drop. Right.
So in some ways it's.
Yep. And in speaking with that, so the Vix Volatility Index. So folks, you've seen this chart before, but average is about 18 on the Vix. That anticipates what the stock market's going to do over the next 30 days. So today on Friday, we're going to hit close to 28 on the VIX. So again, it's called the chop bucket. So between 20 and 30 is a chop bucket, and anything greater than 30 is not good. So we could hit over 30, and then you'll see even more volatility, which is a deeper quad 4 in Q2.
Yeah.
So hopefully we don't get down there, but we'll see. The markets are telling us a story here. So
that's right.
And the Fed 10-year, okay, so the 10-year note, hit 1.91 earlier this week. It's already down to 1.73, 1.74. So, people say rates are going to go higher, not necessarily. So, we have the bond buffer there, the appropriate allocation and everything like that. So,
sure. Yep. Get those brakes pumping.
You got it. Yeah. So, interesting thing here. Just getting a couple little stats and facts. This comes from Kiplinger's as a February magazine, personal finance, all that. So people are now reversing a shift, and they're retiring earlier now than versus the Great Recession in 08-09. So going back, adults 55 plus, Q3 2019, it was 48.1%. So 48.1% of folks who are 55 and older, going back to Q3 of 2019, are retired. Okay, they retired. Now, in Q3 2021, it went from 48.1 to 50.3%. So, over 2%, 2.2% higher. People are, due to many things, just COVID, you name it.
Sure.
Job, wages, just don't want to deal with all the vax, not vax, corporate, hybrid stuff, going to the office, not, and all what have you. So it's just interesting how, house values have grown, portfolio values have grown, people are feeling more comfortable about their net worth. So that's why people are retiring. But 55 and older, I thought that was interesting.
Sure.
And then Right.
No, I was saying, I wonder how many people are just of that. It's, hey, I'm tired of what I'm doing.
Right.
I'm going to take some time.
Yeah.
And
maybe go back in.
Maybe go back in or do something completely different, part time. Do
Consulting,
some, less stress. You know, it's kind of like, hey, I'm good financially, or I'm close.
Yeah.
I'll take a chance, maybe.
Well, good point, because we have seen our clients do that. I've had clients just pick up, leave, go to Carolina, lower taxes, along other things. But just different careers, what job, you name it.
How can I make this work?
Right. That's exactly right. And then we'll end here with to find a list of age-friendly employers. So employers who are age-friendly, who are looking to hire older folks, go to this website. It's institute.agefriendly.org. So institute.agefriendly.org. It is a great website. It's just top companies are looking for older folks because they're focused on more flexibility and things of that nature. Getting in maybe to the COLA for Social Security. Let's talk about a little bit of that. A lot of nitty-gritties.
There's a big raise, right?
How much? It's 5.9. So 5.9 that we talked about earlier. Okay, folks, you're walking a little taller, a little spring in your step. Okay, great. You got a little more money affected in January here for your Social Security payment. Biggest increase in 40 years. Okay, lovely. Okay, goes back to inflation. But however, the Medicare premiums, this is coming from Investment News January, so I just want to read you a few little stats here if you don't mind. So it's going to be offset. So the big increase, unfortunately, for Medicare premiums will offset much of the income. So the standard Part B Medicare premium, which is annually automatically deducted, from their Social Security benefit, had an increase of 14.5%. So 14.5 is your increase in Part B Medicare premiums. Again, you made 5.9, but Part B is 14.5. So that's for 2022. So the amount that will be deducted is $170.10 per month. So it was $148.50 per month last year. Went from $148.50 to $170.10 this year. So it's automatically deducted from those who are on Social Security. Yeah. Higher income earners obviously have the IRMA surcharges. That's an extra $68 to $408.20 per month per person. So if you're at a higher income, be aware of that. Also, Medicare beneficiaries, you can choose to have your Part D prescription drug charges as well, and you can have that automatically deducted if you want to or not. But again, they're subject to higher income IRMA surcharges too. But Part D drug premiums, that increase, that's an extra, Part D surcharges is an extra $12.40 to $77.90 per person per month as well. And the national average Part D prescription drug plan is $41.69 is the national average in 2022. So a lot of numbers I threw out there, but just know, so you had 5.9 COLA for Social Security benefit. Part B went up 14.5. Your premium's now $170.10 per month. Part D drug charges went up. The national plan's now $41.69, and then obviously you have the IRMA surcharges for higher incomes for Part D drugs and Part B as well. So just sort of be aware of that minutia and what's going on.
Sure. Yeah, it's good to know.
Yeah. No, it's and then anything else on? Before I change over to the 529s, anything else you want to talk on the markets or economy or?
Yeah, no, I was just, reading this morning that, from, Argus had, they said that with, anytime there's a year, there's the stock market, the S&P is up 20%. Plus total year, the S&P has delivered a better than average 11.7 total return the following year. So we'll see.
That'd be great if he's right.
Yeah. So
high single digits is what we're predicting, but we'll see.
Yeah, but I guess so if you're an investor, right, and you're looking out, you're look at the news. You come home, you see the stock. Well, the market's down again. It's been really since the beginning of the year or earlier than that. Things have kind of curled over and not been performing as well. Gosh, my account's down. 6, 7, 8%. Well, it's easy to panic, right? It's easy to what's going on, but But really, the best advice for really any investor is be diversified, understand what's going on. It's not the end of the world. You just got to buckle in sometimes. As we know, I mean, we all went through COVID and we, 2008 and the market does what it does. And sometimes you just got to buckle in and say, look, we'll get through this.
And to that fact, I mean, I saw something earlier today as well. 52-week highs. Companies that are hitting 52-week highs are Procter & Gamble, Hershey's.
Okay. Interesting.
You're stable.
Yeah, consumers.
Yeah. So that's, versus the 52-week lows, i.e. Disney. Disney's at a 52-week low today. So the stuff that's volatile, i.e. the meme stock, stuff that was great in 2020, the stuff that...
Peloton.
Yeah, Peloton, that's great.
Well, you bought a Peloton.
Yeah, sure. I need one, but no, the stuff that worked for the last 2 years won't work this year. So it's high quality dividends, cash producing companies, not all this fake, artificially propped up stuff. And then going back to hey folks, to remind you of that chart, remember the 5% pullbacks?
Yeah, okay? That's right. Yep.
So 5% pullbacks, we had one last year. Average is 4.6. So, and we said last December, we're going to have north of 5. So that was our prediction. We're going to have north of 5% pullbacks this year. So, it is what it is. A correction's more than 10%. So parts of the indexes have already corrected.
Yeah,
although S&P has not hit a correction. They're down 6% or so, whatever. But, 4 or more so percent, and you're in a correction mode for the S&P. It can happen, especially if Fed raises rates. Yeah. Just, it's not fun. Know that it happens. A correction once a year is average. It happens. We haven't had that in over 18 months. Yeah. Pullback of 5% happens over 4 times, almost 5 times a year. We had 1 last year, 12 the year before. So we're going to be due. So just strap in. We got models, portfolios made accordingly. So we too, this will pass, but we're on it. We're on our calls and research centers. We're all over it. Yeah. Transitioning maybe into this 529. So just excuse me here, just to show you, articles 529. So, we use this for kids, clients, all that good stuff. But it's really, a quarterly newsletter. I'm just going to extract and give some highlights because it really is.
So 529. So it's for kids, for college?
College, yep.
Okay.
Private, yeah. Even you can use it for, anything now. You can pull money out, $10,000 a year, K through 8, high schools. College, primarily for college, but now you can use it for pretty much anything. That's qualified expense.
Dance classes?
No. Okay. Don't let me go down that. You're killing me. So just a few things on the newsletter that I just held out and extract. So there's an annual gift exclusion. Remember, $16,000. It went up from $15,000. So grandparents, what have you, can gift money per person, per kid, $16,000 a year. No tax to you, the gifter, or the giftee, the receiver. So that's great to use. The per account limit in Ohio 529 plan is now $517,000 you can shove away. Mm-hmm. Not that you will, but you can put that much into it. It was $462,000, so nice big increase there. Yeah. Because what goes higher? College costs.
Yeah, really.
Unfortunately. Annual fees for the Ohio investment option 529 plan was reduced by 1 full basis point. So they lowered the fees. That was as of October 1st, 2021, due to the plan hitting certain AUM thresholds. So Ascensus College Savings is the record keeper for them. They reduced their admin fee and an overall internal cost fees for funds. So reduced a total of 1 full basis point, which is great. As of 9/30/2021, the Ohio 529 program, they oversee about $15.93 billion. So obviously hit a $15 billion mark. That's why you get a little lower fee. So the more they make, you get lower fees called breakpoints, things of that nature. Yeah, there's over 670,780 college savings accounts that are open, 780 college savings accounts. And I have 2 of them, so I'm part of that. And Andy's and his clients, our clients use them as well. Plenty of accolades from Morningstar, Forbes Advisors, CNBC, what have you. But just some stats real fast. So the plan, the Ohio 529 plan, is ranked number 1 in the nation for the best investment performance in the 3-year category average. Best over the past 3 years.
OH.
Ohio. So that's awesome. Number 1. And then number 5th in the nation for best performance investment class in the nation for the 5-year average. And 2nd in the nation for the best average over 10 years. Hello,
that's
drop
great.
the mic. So best first, fifth, second over the third, fifth, and 10-year national averages and for performance-wise.
Yep.
And there's a new app. I've been waiting. I was going to talk about last episode, but I didn't. I wanted to wait for it's up and running, get the kinks out. I tried it. It's awesome. So it's a Ready Save 529 app. So those clients of ours who do have the 529 program, get on the app. It's a Ready Save. Type in Ready Save 529 app. And then it has a nice overview. You can see your accounts. You can add money to it. You can invite friendly and families to UGift. UGift is great. I did a test with my brother, so thanks, Mark. My daughters will enjoy that. But it's just an easy way. You send an email. You set up a username, password to the UGift account. You can contribute as little as $25 up to whatever you want. And it goes right into the child's account directly. Birthdays, holidays, graduation gift, instead of toys and junk, that come and go. So it's a great way to do that for your family, loved ones, what have you. So get on that app. Plan's great. Again, you can use it K through 8, K through high school. You can use it for colleges, any accredited colleges. For the factor, it's only 5.6% used against the college funding factor. So if it's held in the client's name, beneficiary is the children, the child, only 5.6 roughly is the percentage used against any funding formula for college grants, FAFSA, and all that. Yeah.
Yeah. So if I have a grandchild and they have an Ohio 529 and it's already set up through their parents, I can contribute. Mm-hmm. And I get if I contribute in Ohio, I do get a state tax credit.
Yes, if you're
but you don't have to, right? So if you have kids that live out of state and they have 529s through their state, you can still contrip to those plans. Yeah. You just don't get the state tax credit.
Correct. You still don't get the state.
Because Ohio they try and incentivize. Right?
Good point. Excellent.
Yeah. Or if you have if there's multiple kids, right? Yeah. One kid gets a scholarship, doesn't need it, you can transfer his account over to the other one.
Right. Yeah, you can always change beneficiaries anytime.
Change the beneficiaries, use it for grad school, law school,
anything.
Med school,
computers, books, room and board, trade school, 2-year degrees. So college is not for everyone. So Andy and I are big believers. It's over. Unless you're a doctor, lawyer, and need it. No, you don't need necessarily a 4-year degree. So there's plenty of money to be out there in a trade school and other things that are out there. So yeah, you can always very flexible. And you brought up a good point, for the state tax, it's $4,000. So nothing huge, but the point is $4,000 per beneficiary per account holder. So, I have 2 kids, that's 4 and 4, it's $8,000 top line deduction. Boom.
So sometimes it makes sense. Sometimes, yeah, it's good. It's a good plan.
So I just wanted to hit on that. Tips of the month. I want to hit on a couple of things. So one would be the student loans, talking about colleges. So what's coming back? And,
student loan payments.
On May 1st. All right. So folks.
You hear the big cha-ching.
Cha-ching. It's the vacuum. Okay, so the savings was great during COVID because, everyone got plenty of savings. The savings rate up to 30%. Now it's down below 6% national average. So people have spent their money. Retail sales are slow and things of that nature. But student loan, in addition, it's going to kick back in. So as of now, again, they keep on pushing back the bucket, the start date, what have you. But it's May 1st. There's nearly 43 million people have federal student loans totaling $1.59 trillion.
Yeah. Well, that's about the size of Yale's endowment fund.
Amen. Oh, yeah. I know. Some of these endowment funds for these colleges is crazy. Yeah. With national balance average is $37,000. So approximately $37,000 is a national average balance for a student loan for these 43 million folks who do have federal student loans. And this is all according to the Education Data Initiative. That's where it's coming from, also through Investment News as well. So we just want to point that out. So since we're hitting all the college stuff, to get that point out there. Let's see. Bengals, they going to pull it off, you think?
Hopefully. I don't know. They look pretty good. I don't know anything about Tennessee.
I'm with you. No, it's going to be challenging, but hopefully it's a good game. Got to root for the quarterback, though, from Athens. So, Joe,
absolutely.
He's a good guy. But I know we covered a lot. Not quite as many visuals this time around. Just the markets are going to be volatile. We hit on that.
Yeah.
We have a game plan in action. Comes down to the Fed, real simple. If he raises rates, see more red. If he doesn't raise rates, there's your floor. Markets will go off. So we'll be actively managing things and making our adjustments accordingly. We appreciate you all. Stay
Yes.
healthy, right? That's the key.
Absolutely. Yep.
And another, month or two of this stuff. Get through springtime. Can't wait.
Yeah.
Get back out there. Get you on the
Exactly.
links. You and I
Yeah.
did I play it all last year? I don't think I did.
I don't
think so. So hopefully I get out next year. Maybe one time. We got to go golfing more. That's one thing. Crazy.
Yeah.
All right, guys. Thanks
All
for
right.
everything.
Have a
Call us.
great-
Reach out to us if you need us.
Thanks, everybody.
Take care.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.